What's up, trading bros and sisters? Welcome back to the Trading Floor Weekly Review. Your boy Wildcard, TB on the keys, Saturday morning, week 18. I'm going to open this show with a contradiction. You ready? SPY closed green this week? Beautiful. Green. Hold that in your head while I tell you the rest.
Good morning.
Good morning. Real quick before we dive in, nothing we say here is financial advice. We are two guys on a Saturday morning looking backward at a week that made absolutely no sense. Everything we say is for entertainment and education. Do your own homework. Don't YOLO your rent money because Wildcard said so.
Same for me. System data I share is real, but past performance tells you nothing about what happens next. Every position we mention is our own, not a recommendation.
What he said. Okay. SPY closed up 1% on the week. Green. VIX collapsed 11.56%, sitting right around 17. On paper, great week. Beautiful week. Love it.
Now flip it.
Now flip it. West Texas crude closed at $102 a barrel. That is the highest price since the Iran war started. 12 mines confirmed in the Strait of Hormuz. Iraq declared force majeure. The UAE walked out of OPEC after 60 years. The physical world got worse this week. Not better. Worse. And the index went green.
Because Google had a blowout quarter.
Because Google had a blowout quarter. That is the entire week in one sentence. One earnings report from one company papered over a physical world that is actively breaking down. Two markets. One index. The paper market relaxed. The physical market escalated. Both of those things cannot be right forever.
The divergence resolves eventually. Divergences always do. The question this week is not if, it's when and what triggers it.
That's what we're going to prove. Let's go. Exxon. I want to start here. The CEO of Exxon. Not a Reddit user. Not some on FinTwit. The chief executive of the largest Western oil company on earth. Went on record this week and said the market has not seen the full impact yet. He didn't say things look rough. He said the market has not priced it. He's looking at the same SPY chart we are and telling you to your face that number is wrong.
The Strait of Hormuz context matters here. 20% of global oil supply, 1/5 moves through that strait. Right now, there are 12 confirmed mines in the water. The Navy is clearing them, but mine clearing is not a fast operation. And the mines are not the only issue.
Iraq force majeure.
Iraq declared force majeure on export contracts. That's a formal legal declaration saying they cannot deliver what they promised because of circumstances outside their control. This is not a press release. This is suppliers calling buyers and saying we cannot fulfill the contract.
And then UAE.
UAE exited OPEC after 60 years. And I want people to think carefully about what that actually means, not just the headline. UAE was the moderate voice in that room, the country that maintained relationships with everyone, that argued for pragmatic production policy, that kept the cartel from its worst impulses. When the moderate voice leaves the room, who's left?
The hawks. The countries that need oil at $100 to balance their national budgets.
The internal logic of OPEC just shifted. That's the real story buried under the exit headline. The futures market is pricing in resolution. The mines get cleared. Iraq comes back online. UAE's move is political theater. Oil cools off. The physical market is pricing in escalation. One of those desks is wrong. They cannot price the same barrel that differently for very long.
Something's got to give. TB. Earnings rubric. You're up.
The market built a grading system this week and applied it to every single company that reported. The rubric had one question: show me receipts. Show me revenue that already happened, not spending that might pay off someday. Prove it in numbers that are already real or get punished. That's the whole rubric. Let me run the report cards. Google. AWS. Up 11.48% on the week. Cloud backlog doubled. Revenue already in the door, real numbers, not guidance. But the bigger story is what this quarter means for the entire market map. Google is approaching $5 trillion in market capitalization. That puts them on a path to potentially overtake Nvidia as the most valuable company on Earth. And here is the structural story inside that number. For 2 years, the market paid peak prices for picks and shovels, the chips, the hardware, the infrastructure layer. Nvidia was the trade. Now the market is rotating. It's starting to pay for mine output. The companies that took AI infrastructure and built real revenue with it. The application layer is being revalued above the infrastructure layer. That is not a trade. That is a structural rotation.
Apple, up 5%, guided well above what the street was expecting. But I'm going to give you the single most impressive line item from the entire earnings season, the one nobody is talking about enough. China revenue, up 28% during a trade war. I'll let that sit.
That number should not exist in this environment.
It shouldn't exist. And yet, moving on.
Nvidia. Citigroup minus, maybe a D. Top line revenue is real, and it's big. But the China write-down evaporated $26 billion in annualized margin. Gross margin compressed from 71% to 60%. That is 11 points of margin. That is not a rounding error. That is a structural number. The picks and shovels premium that justified Nvidia's valuation was built on that margin. The margin is cracking.
Which connects directly to what you just said about Google eating the throne.
The rotation from infrastructure to application is visible in these two report cards placed side by side. Google goes up 11%. Nvidia goes down 5%. Same week. Same market. The market is telling you something, and it's not subtle.
Meta, Thord, down 9.28%. I'm going to make this quick because one sentence is all it deserves. Meta told the truth about what AI is actually costing them and what it's going to keep costing them. The market penalized them for it. Companies that gave vague guidance, fine. The company that put specific numbers on the table, torched. That is the honesty tax.
Wave Trader scanned 300 signals this week, took 4. Flat on the cycle. The system's in preservation mode while it waits for the divergence to resolve.
TF held AMD, Avgo, and CCJ, the infrastructure layer under the hype. 94% cash. Didn't chase Google. Didn't catch the meta knife. System stayed disciplined.
Segment 4. I want to talk about OpenAI because this story and the Nvidia segment are the same sentence written in 2 different languages. OpenAI. I missed revenue targets this week. And missed user targets. Same week. Same reporting period. That is an unusual combination on its own. But their chief financial officer was on record this week claiming a, quote, vertical wall of demand. Both things can only be true at the same time if the demand is real, but the conversion isn't happening. People want II. They don't want to pay full price for AII. That is not a demand problem. That is a structural monetization problem.
The cathedral's full, but nobody's buying the tickets.
Right. And this connects backward to segment 3. If the end user II layer, the OpenAIs, the companies building applications on top of the infrastructure, cannot convert demand into revenue, then the story that justified every chip order, every hyperscaler build-out, every data center lease, that story has a ceiling. The Nvidia margin compression and the OpenAI revenue miss are the same sentence written twice. The infrastructure got built. The monetization layer is still being figured out. That ceiling matters for everything priced above it.
And now, I'm going to completely whiplash you into the most unhinged story of the week. GameStop. GameStop is bidding $9 billion for eBay. eBay is worth $46 billion. GameStop has $9 billion because they sold stock to retail investors, including probably some of you listening right now. Their executive compensation plan requires a $100 billion valuation to trigger payouts. If you combine GameStop with eBay, maybe, you get there. Do you see what happened? The acquisition target was selected by the compensation structure. The comp plan chose the target. That's the whole story. I have nothing else to add.
That is either the most sophisticated corporate maneuver I've seen in years, or it is complete chaos, and I genuinely cannot determine which one it is.
It's both. That's the GameStop brand. Always has been. Alright, week 18 is done. Let's talk about who inherits it. Personal consumption expenditures came in at 3.7% this week. 3-year high. Inflation is back, or more accurately, it never fully left. The bond market is now pricing in zero rate cuts through all of 2026. Not one, zero. The market has given up entirely on cheaper money for this calendar year.
And into that environment, a new Fed chair takes the seat.
Jerome Powell is technically no longer the Fed chair after May 15th. Kevin Warsh takes over. But Powell is staying on the Board of Governors. He is not leaving the building. And that is not normal. The last time a departing Fed chair stayed on the board after being replaced was 1948. First time in modern Federal Reserve history. Powell is staying, and everyone inside that building knows why.
Warsh's inheritance on day one, oil at 122. Personal consumption expenditures at a 3-year high. Zero cuts priced through the year. A geopolitical supply shock with no clear resolution timeline. And one more thing I want to add to that pile.
The bond market.
The 10-year Treasury yield moved from 4.31 to 4.38 this week. Small move. Most people skipped it. But watch 4.50. That is the number where mechanical selling triggers kick in. Pension funds, risk parity desks, rule-based strategies that have triggers baked in at the mandate level. When the 10-year crosses 450, those mandates require selling equities. The selling becomes automatic, and automatic selling creates momentum that feeds itself. Warsh doesn't just walk into a burning building. He walks into a burning building, and the fire alarm has a tripwire set at 450.
And he has no room to cut rates.
And he has no room to cut. If oil stays above 102 and the 10-year crosses 450 in the same week, we are not talking about rate cuts anymore. We're talking about whether rates need to go higher, into a supply shock, into a 3.5% unemployment rate, into personal consumption expenditures at a 3-year high. That is stagflation with a new conductor walking into the pit on day one.
One number before I close this out. VIX at 17. Oil at 102. One of those numbers is deeply, fundamentally lying. That divergence does not hold. Monday opens week 19, and week 19 is where the market has to pick its reality.
VIX at 17, while mines are in the shipping lanes, is either the most correctly relaxed the market has ever been, or it is catastrophically wrong. I have a strong intuition about which one. Monday tells us.
18 straight weeks. 18th weekly review. We just keep showing up.
Consistency.
What to watch in week 19. May 15th. Warsh takes the chair. His first public statement tells you everything about how he plans to handle this situation. Listen to every single word. The 10-year yield. You know the number, you know the tripwire. 450. Oil above 102. Any move toward 110 breaks the VIX divergence fast and hard, and everything reprices simultaneously. GameStop. The eBay bid either formalizes or it doesn't. Either way, the board has to say something. This gets strange in a hurry. OpenAI. They know the conversion number was bad. Something is coming. Product announcement. Pricing change. Something. Watch for it.
And Warsh's first week in the seat. How a new Fed chair responds in his first 72 hours on the job to simultaneous stagflation signals and a geopolitical supply shock. That is information the market has been waiting months to have.
2 markets walked into this week. One of them's lying. We'll find out which one when the receipts run out. See you Monday, trading floor.